Hey traders, happy Sunday. This is Ron Haight. I hope you guys are having a great weekend. As always, everything in this presentation is for educational purposes only. We'll kick off here using a daily chart of the S&P 500, the Spiders ETF, and this is Thinkorswim. This is the previous high, as we can see, back in February before the COVID hit, and then our most recent high here at the early part of September. Let's go ahead and zoom in. And I told you guys to watch the 50-day SMA in orange. That is the big institutional line in the sand. And that was in my previous videos. We broke it on the 18th. We then followed up on the 23rd with bearish engulfing. This was not a good sign. Since the markets tried to rally, and I said to you in last weekend's video, watch the 50-day. We get above it, the bulls get the edge. Otherwise, the bears keep the edge. And what happened? On the 28th, we hit the 50-day and we're stopped. The 29th hit the 50-day and we're stopped. 30th hit the 50-day and we're stopped. It's like you can't make this up, right? And then finally on Thursday, this past week, we get above the 50-day, but we have a solid solid green bodied candle. What does that mean? Well, the previous day we closed right there. Then we gapped up at the market open, but then we closed lower than we opened. There just wasn't a whole lot of confidence that once we got above the 50-day on an opening basis to just say, all right, here we go, and the bulls come flying in. They actually took some profits versus just ramping it higher. And then what happened Friday? We gapped lower down there, closed up here. So that's a hollow red body candle. We closed higher than where we opened, but we're still below both moving averages. The 50-day in orange, the institutional line, and the 20-day EMA in red. So using the S&P as a proxy for the broad market, the bears still have the edge here. There is not a lot of confidence on behalf of the bulls because when we get above the 50-day, we come off the highs, even on Friday, off the highs. Now, if we take account to where we are, it's the beginning of October. And the subject of the video is, could October become Shocktober? Now, historically, September is a more bearish month than October, and we had our pullback in September. That's why seasonality is just so incredibly powerful. You could say, how could we just turn on a dime? From a probability basis, September is the month where the turn happens, and down we came. Now that October's here, we have earnings season in 2 weeks. We have the president with COVID. We have the elections. There's a lot of big events that could cause a shock, October becoming Shocktober type situation. So how would I want to trade it? Well, number one, I would go back to what we always do. Watch the volume. If we have days where the candles are solid red, we're closing at the lows, volume is increasing, it's clear, no matter what the headline is. Because if you watch mainstream media, it's incredibly biased, again, just like it was 4 years ago. So this isn't an endorsement of the president. It's just the way the media seems to be. So it's always going to be negative, and that can paralyze traders. So I would say put your fingers in your ear, ignore everyone, whether you like the president, don't like the president, whatever that might be. And let's just go with what the volume is, go with what price direction is. And it's a lot less emotional. I think it gives your freedom back instead of worrying about this, that, and the other thing. So this week, bears technically have the edge. Now we're going to dive into some of their indexes, and it's going to be a mixed bag. What would I say to you in next weekend's video? Hey, we need to get above the orange line. That's step one for the bulls. We absolutely have to take out that high there, and I still want this one because that was bearish engulfing too. So for the S&P, I would consider putting alerts around 342 on the SPY. We close above there, and we get decent volume. What does decent volume mean? At least average volume. We want to see candles closing near the highs of the day, not all this selling off the highs and quickly taking profits the moment the bounce happens. That would be the showing us a sign in trader or investor sentiment. Now looking out on this chart, here's a high, there's a high, there's a high. We still have lower highs. Here's a low, here's a low. We still have lower lows. Again, bears would have the edge. If I switch this to a weekly chart, we look at 3-year weekly, we're still holding above the 20 period on the weekly. The weeklies have not broken down like the dailies have. When the weeklies also break down with the dailies, that is just a really bad sign for the market. For the bulls, great for the bears. All right, let's go back to the daily. And I hope that analysis is helpful because I'm getting a ton of questions on wondering if the market could absolutely crater if bad things happen with the election. We could. But we could also sit here and just worry ourselves to death and, be deer in the headlights and not do anything. I prefer just to watch what is the big money doing? Up, down, are they doing nothing? Right now, the bears still have that edge. and you know what to watch for. So here are the diamonds. This is the Dow ETF. We have not set new highs. We go ahead and zoom in. We did not get bearish engulfing here, but it was pretty close. We did get it here. We got it here. Then a U-turn happened. Now with the Dow, we cleanly got above the 50-day in orange, the institutional line. Wednesday and Thursday. Friday we dipped below it, and then we got back above it. Speaking, purely technical analysis, the bulls have a slight edge on the Dow, but the S&P is a better barometer given it's 500 companies. Yeah, they're not all equally weighted, but it's still 500 companies where the Dow is not, right? It's only a few companies. So we still have lower lows as well. I'm sorry, lower highs. And here we still have lower lows. Even though we've gotten above the 50-day, there's no new high. There's no previous break of that swing high. So for the Dow, I'd probably put it around 283, ballpark it for alerts. Also, this could be left shoulder, head, right shoulder, inverted head and shoulders in the short term. I don't like inverteds near all-time highs, but we also have potential head and shoulders. Left shoulder here, head up here, right shoulder here, but then that was the break of the neckline. The head and shoulders isn't working out that well here, but once the neckline was broken, we got back above, we didn't set a new high. Could we, eliminate that and say maybe there's still a head and shoulders in play because this is the right shoulder? And that was one of the questions you guys emailed in about. Yeah, it's possible, but here's what I would do. We're starting to make excuses. When you start making excuses when you're looking at charts, it's just not a good thing. I would not say a typical standard head and shoulders is in play in the Dow on the daily chart. If I go back to the S&P, nada there either. Let's go to the Qs. The NASDAQ, which was performing the best. Previous high was here. Now we're way up. We were way up there. If we zoom in, we have this U-turn type pattern. Hit the 50-day, broke the 50-day, but we couldn't get above the 20. Very interesting. Down we go. We keep hitting our head. But back on Monday, we got above both the 20 and the 50. Now, when that happens, that's a technically bullish event on a chart. We look at the volume right there. Volume is pretty decent. It doesn't need to beat out the previous bars. We just wanted at least average or above, and it was. We get a little bit of a push, and look what happened on Thursday, guys. We actually took out these swing highs. That is very noteworthy, and the only down day was small volume. It looked like the NASDAQ wanted to go, and then what happens Friday? We actually lose both moving averages, the 20 and the 50, and a spike in volume. It just didn't pan out. And I want to bring this to your attention that nothing is ever perfect, whether it comes to technical analysis or any trading system. This looked like we might have a shot at moving here. And then it was all for naught come Friday. Now the target, we back down to these lows around 262, give or take. If the bulls come back this week, they need to take out not just the previous, where I said the watch point was around 281 or so. It's got to take out the latest swing high, which is now 282. We break above there, then the target is up there. So Qs this week, they would also be technically bearish. So SPYs and Qs bearish, DIA bullish. Let's look at the Russell. Indigo Whiskey Mike, the Russell 2000. Again, definitely not nowhere near the highs. We did have a nice little move on Friday. It was even a little bit of bullish engulfing. We have a U-turn type pattern with bullish engulfing here. That all sounds great. There's a high, lower high, lower high, lower high, lower high. We have not set a higher high yet. Low, 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 lower lows. Even though the IWM is just pennies above the 50-day, at best this thing is neutral, and I would still give the bears an edge here because we have lower highs and lower lows. If we look at the VIX is still in a bullish posture. It's interesting how it just keeps tagging the 50-day moving average. Tags it, bounces, tags, bounces, tags, bounces, tags, bounces. VIX here is still bullish. There's nothing diverging here. Overall, recap, I would stick with the SPYs as the guide, SPY. It is below the 50-day. Sure, it's not by much, but it's enough. Bears have a slight edge this week, and October could still be Shocktober with all these headlines. We'll just follow the price volume. Now, let's take a look at Apple. How is Apple doing? That'll be how the market's doing. Apple is just barely below its 50-day. We did see it starting to break higher, but we never cleared the previous swing high. Apple was lagging. So if you use Apple as helping hand here to gauge how the overall market is moving. You never hit a higher high. We never took out a swing high. That was a negative divergence. And it's rare historically just to use one stock as our guide, but Apple's been that now for probably a good decade. It's the one stock that really gives you the heads up right now on what trader sentiment is doing, feeling. Here is Google. We broke down, took out previous lows. We're now bouncing into the 20-day. This is classic. And look at this. Once we broke the 20-day back in the beginning of September, when the market overall began to correct, 1, 2, 3, 4, so almost 5 straight days, we can't get above the 20-day in red. And then we hit it last week on Wednesday, Thursday, rolling over. Immediate targets down around 14. This is just ballpark, 1409, and then back down here towards 1350. Let's take a look at Netflix. There we go. Still range bound. There's been no change. Thursday was a really nice thrust higher, but from a reward to risk perspective, you basically got a big old range. Your target upside is in the 550s, 560. Downside here is 460. It's a $100 range. There wasn't a whole lot left. So I would prefer personally, if I was going to trade Netflix, for it to break out of that box. Amazon, it got above its 50-day for one lousy day on Thursday, right back below, and the volume picked up. This is not a good sign if you're a short-term bull. Targets are now going to be the previous lows around 2,900 or so. It would need to get back above the 50-day and take out a previous swing high, which is up around 3307, it seems. How about Microsoft? Same story. However, it did get above the 50-day on Monday. Actually, no, it did not. Intraday it did, but we closed back below it. So we opened there, closed there, got above it here, closed off the highs. It's showing you that the bulls don't have the conviction to start ramping things higher. They're not feeling that comfortable. When we start to get up there, we close lower. Look at all these solid red candles. We're closing lower than where we opened. How many of these are solid? And then when the bulls come in and we have hollow green candles, we're opening there, closing higher. So we have solid greens, but there's no real estate being gained in terms of price. And we roll right back over. So Microsoft is bearish. Facebook, really only one day, and we're right back below. Now volume didn't pick up, but this still this actually would. There's your head, almost double top, left shoulder, possibly maybe a right shoulder over here. But I wouldn't like this as a head and shoulders either, because all this chop, there's no like big drop for the stock to make. There's air pockets. This is all trading range, and we tagged the top of that trading range just a week and a half ago. Initial support's going to be 246-ish, and then back down to the 220s. You need to take a look at something that is still amazingly strong, and that's NVDA. I've brought this in a few times. Until it cracks that 50-day, bulls, 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 and bulls have the edge. Tesla, basically a trading range, a big bull flag. You could also draw a pennant, trend line from there to there, trend line from there to there. This thing is still bullish. AMD had a question on this. Seasonality, right on target in September. AMD does not have a good September. Bearish engulfing. The moment that printed, as an aggressive trader, you could paper trade this. The thing goes from what, 90 at the end of the day, right down into 75. That's a huge move in a matter of what, 2 weeks? Now it broke the 50-day, and now it's gotten back above. So it's a little mixed right now, but from a seasonality perspective, the move is essentially over. This was the move. Technically, yes, it's bullish, but if it gets back below the 50-day, it would be a no-go from a bullish perspective. Zillow, another hugely strong stock. Folks are wanting to get out of cities. They want to get out of high taxes. They're leaving, for what it's worth, they're just running from typically blue-held states like California, New York, New Jersey. Their taxes are so oppressive. And Pennsylvania, where I'm at, is not a whole lot better, but we're not that awful in comparison in terms of the tax burden. But they are running from California, running from New York, running from New Jersey. These places are talking about exit taxes, where if you try to leave, they want to, put a, they just want to nail you with taxes, to get out. And as a result, people are using Zillow like crazy, getting out of big cities, moving elsewhere. Until this stock, and by the way, it's happening here in Pennsylvania too. They are exiting Philly. They're running from Jersey into Pennsylvania. The real estate market here is also very hot. Watch for a break of the 20-day. Watch for a break of the 50-day. The 50-day was the last time it was major support back in July. Until that happens, the bulls get the edge. Now, if I was trading Zillow and I wanted to sort of see how long I could stay in a trade, for example, again, from educational purposes only, let's say I had just 200 shares as an example, or maybe 2 long calls. We'll just keep it very basic. Half the trade is exited on a close below the 50, below the 20-day in red, and then a full close below the 50. If these were sort of short-term trades, if these were bigger trades for me, I might consider, when we breach below the 20-day, maybe some covered calls, maybe scaling into some protective puts. But the real break, the real last line in the sand is your 50-day. And then gold and silver, right on target, guys. I said, please watch the late summer, early fall on gold. Why? Because look at there, beginning of August, and then we start trending lower. Look at the lower highs. We've broken out of that horizontal support, ballpark 179-ish, 178-ish. We've come back up and hit it. Gold is bearish on the daily chart. Silver, same thing, put its high in August. Breached the 50-day. This is a bear flag. You look at the gold miners, put the high in, same thing, lower highs. We've broken, this is really nice. The previous lows are right around 40, 39.40. We're back testing, we're falling down. This is also bearish on the daily chart. Here's your silver miners, same thing. They're not above their 20-day EMA either. This is a bear flag. For any of these gold, silver, the miners to be bullish, first off, they got to get back above the 50-day. And if I go back to gold, back above the 50-day is step one. At least that relieves the bearish pressure a little bit. But then we got to take out 1 or 2 of these swing highs to show that there's an appetite to close stocks at the highs of the day, and not when we get up there we start selling. And that's why you see these dark green candles again. It's like, oh, here's a rally. We gap up there and then close there, close lower than where we opened. We gap up here, close lower than where we opened. We make another charge, gap up here, close lower than where we opened. And then you look at these red candles, open, close, open, closed, open, close. We're closing lower than where we opened. There is a clear exit right now. That doesn't mean gold and silver would potentially crash as an odds-on bet. We've entered the window where money typically comes out of these and it shifts into other places. All right, guys, we'll wrap it up there. Get ready, because we are coming into, not only could this be Shocktober for a lot of news events, but we are entering the best time of the entire year trading. I'm going to be holding some special events, so keep your eyes out for those invitations, because as we get towards the end of October into the middle of December, it is one of the best trading times of the entire year. That 45 to 60-day window literally makes your year, and it seems to happen every single year. So we're going to start talking about what stocks to watch. We are getting really, really close. It's super exciting. So I wish you and your families all the very best. I will be back with you probably only in the weekend video unless things really get wild and crazy this week. Take good care.